Hello everyone, this is Bill Hall for Money and Markets. It's Wednesday, August 27th, and I'm pleased to bring you my financial insights in this new and exciting podcast format. Let's get started by jumping right in and looking at our first slide. And this first slide shows the most important thing that investors should be focused on, and that's the fact that we live in a slow growth world. Indeed, if you look at this chart, what you see is that the growth in the current recovery has been the slowest that we've had in all recoveries dating back to the 1950s. So yes, we are indeed in a slow growth environment. And looking at our second slide, we see why growth is so important to investors, especially stock investors. And that's because there's only three components of stock market returns. Yes, that's right. There are three and only three elements that drive stock market returns. The first is dividends. The second is the earnings growth rate. And the third is the change in the price earnings ratio. You add the three together and what you get is total stock market returns. Let's move on to our third slide and you'll see an example of what I'm talking about. Let's look at the returns in 2013 on the stock market and how those were generated. What we see is that the market returned a whopping 32% in 2013. And the components of that return were 2% of the 32% was from dividend growth. 5% of the 32% was from earnings growth. And the biggest piece, by far the biggest piece, as you can see here, was 25% of the 32% return came from the fact that there was a change in the PE ratio. What that means is that people were simply willing to pay more for stocks at the end of 2013 than they were at the beginning of 2013. So yes, 2013 was a fantastic year. But only 5% of it came from earnings growth, 2% of it came from a dividend, and the remainder, the biggest piece, came from the fact that people were just willing to pay more for stocks at the end of the year than they were at the beginning of the year. While I don't have a slide that shows it, if we think about 2014 in this same context of the three elements of total return, it stacks up about this in a similar way. In 2013, the U.S. stock market's up about 9%, with 2% of the 9% being from dividends, about 4 to 5% being from earnings growth. That's about 6 to 7%, and then the remainder of the return in 2013 comes from the fact that people are willing to pay marginally more for stocks in 2014 today than they were at the beginning of the year. Now the key question becomes, in this environment, what do investors do to make money? What should they be thinking about in a slow growth environment? So when you look at our fourth slide, you'll see that one of the investments that I'm recommending that people consider is business development companies. If you want to know a lot about the detail of business development companies, you can go to the link that I've provided on this slide. But for our purposes in this podcast, what we need to think about is that business development companies do what banks used to do. And by that, I mean that what they do is they make loans to large privately held companies, not super large publicly traded companies like ExxonMobil and Procter & Gamble. They don't make loans to those type of companies. Business development companies don't make loans to mom and pop type Main Street stores. Again, what they do is they make loans to large privately held regional distributors or manufacturers of goods and services. So think of business development companies as filling in that niche that banks used to provide, of providing loans to these large privately held companies so that these large privately held companies can grow and prosper. All of this means that the underlying asset in a business development company is its portfolio, a large portfolio of loans that it's made to these companies. And what they do is they, like a bank, they generate interest income from those loans, and they pass that interest income along to the holders of their stock. So as an investor in a business development company, what you're receiving as a dividend payment is a portion of the interest that the business development company is charging on the loan that it's making to the large privately held company. Now let's look at our last slide, and you'll see two of my favorite business development companies. The first is Ares Capital. The symbol is ARCC. And Ares Capital pays its holders, the holders of its stock, meaning if you buy the stock in this company, you'll receive at its current price, you'd receive an 8.8% dividend yield. That's a cash-on-cash return of 8.8% for investing in Ares Capital. Ares Capital is probably the largest and most well-known of the business development companies. It's been around a long time, and it has a well-established portfolio of loans. Another business development company favorite of mine is TCP Capital Corp. The symbol is TCPC. It yields 8.5%. That's right, a cash-on-cash return of 8.5%. TCPC is much smaller than Ares Capital. It was formed only a few years ago, but that has its advantages because its portfolio of loans are relatively fresh. So there you have it. Two great new business development company investment ideas. Ares Capital and TCP Capital Corp. And the reason I like them so much is because of the big yield that they pay. Because going forward, yield is going to be a larger component of return, I believe, than growth and revaluation of stock. So what we're emphasizing with BDCs is the fact that we get a sizable dividend yield. In conclusion, I'll remind you that BDCs are risky type of investments. That's why the yield is so high. But if your risk profile permits it, I think that you should consider adding some of these to your portfolio. For Money and Markets, it's Bill Hall, and I look forward to speaking with you again next week.